take your seats. The program will begin in 5 minutes. take your seats. The program is about to begin. Please welcome to the stage Bloomberg's Lisa Mateo.
Good afternoon, everyone. It's great to see you all in person here in Los Angeles. Also, for those joining in on the live stream, we are live streaming it, so thank you for joining in as well. Welcome to Bloomberg's The Future Investor, Finding the Opportunities. Now, let's be honest, right? Talking about the economy, it can be a little challenging nowadays. I like to compare it with the GPS on your car when it's recalculating. You think about it, who's been there? Like, I have been there. I'll give you an example, okay? I was driving the other day, driving along, listening to my music, and I was feeling great, and I missed my turn. So what happens? You get off at the next exit, and you wait. It recalculates, okay? So then I go down a winding road, and there's no service. And my lady's still recalculating. You get to the stop sign. What do? Do you make a left? Do you make a right? Do you go straight? What do you do? And she's still, lady, where do I go? Okay? I have to admit, lady was not the choice word that I used, but that's okay. That's a story for another day. But my point is that we're moving, right? There is a destination, but sometimes there's these roadblocks. There's slow traffic. Yes, you might make the wrong turn, but eventually everybody's saying, are we headed in the right direction? I mean, you think about it. Some investors, they are finding new roads. You have companies, some companies, they're getting to the destination even faster than before. So think about how things are going in the times of today, right? Companies have to not only survive, they have to adapt. They have to reinvent. I mean, who would have thought 10 years ago a car company would become a tech stock, right? Or that you'd be getting a monthly subscription to things like, I don't know, toothpaste. It is a thing. My sister has a monthly subscription to toothpaste. So this is the type of time we're living in. Companies are finding different ways to unlock value, right? Whether it's through technology, whether it's through efficiency, or maybe, yes, finding a new revenue stream. So that's what we're going to talk about for today. We're going to talk to different businesses and how they're unlocking their value, how they're finding that long-term investment and long-term value. And then for investors, where they're finding those opportunities amongst all the noise that we're hearing about for today. Now, is everybody with me? Are we all on the same page? Are we ready for this? Okay, so before we get things started, I just have a few of announcements I want to get through. First off, I'd like to thank our sponsor, Invesco QQQ. Without them, we wouldn't be able to have all the conversations we're going to have here on the stage for today. You'll be hearing from them in just a few moments, so stay tuned for that. Next up, we want everyone here to take part in the conversation. How do you do that? You scan the QR code. If you look on each of your tables, there's a QR code there. Scan that, write in your question, and we will try our very best to get it answered on the stage for you here today. And lastly, yes, I have to touch upon social media, hashtag #TheFutureInvestor. That's where you can follow along with different highlights we're going to have for today. And if you post something, maybe there was a nugget of information you learned that you want to get out to the masses, or you saw an old friend, you took a picture. Maybe you met somebody new when you took a picture. Hey, take a selfie with me. I don't care. Post it. Hashtag #TheFutureInvestor. And also tag us over at Bloomberg Live. And be sure to give us a follow when you're there. All right. It is time to get things started. We have our opening remarks right now. Please welcome to the stage Tim McLaughlin. He is QQQ Equity Product Strategist for Invesco.
Hello and good afternoon, everyone. My name is Tim McLaughlin, and I'm the QQQ Equity Product Strategist at Invesco. To start off, I want to thank our partners at Bloomberg for really bringing these types of events to life. Welcome to the Future Investor Series. I've had the opportunity to travel around the country and go to a number of these in the past couple of years, and I always come away with new insights and perspective as to different trends driving market dynamics today, but also what we can expect in the future. This is exactly the type of event that Invesco QQQ should be sponsoring with the focus on innovation. And, I hope you guys take as much from it that I have in the past. So, again, welcome. I'll pass it back to Lisa for our first panel and hope you guys enjoy the program.
It's not bad, huh? Okay, so I was giving an analogy earlier about your GPS and recalculating. So we're going to talk with some companies here who are doing that. They're finding the new roads, right? They're making the new turns and everything that's going on in today's society. So I want to welcome, this is Matt Leiberg. He's with Manulife Investment Management. And then we have Sherry Rhodes. She is with Workday. Sherry, I want to start with you because you have some interesting background. So you're the Chief Customer Officer at Workday, but you've also served as CIO also. So you have a good perspective. So if you can talk to us, the customer is, right, you're central to the company. How is that experience, the customer experience, how are you using that to drive profitability?
Yeah, great question. So I would say a couple things. One, as the CIO and then now the CCO, it's really about value. So as the CIO, it was like, how do I drive internal value for the stakeholders? And then now I get to do it from an external standpoint. But I always tell people I have a lot of empathy for customers because I've been in their seat, right, in terms of driving transformation and change. But for me, it's about how do we create value on a continuous basis, which then hopefully, right, we're part of that growth engine for our company. So I always say it's like coins in the glass jar. Everything that you do for a customer is meaningful. So whether it's small, making sure that you have, solved their biggest complaint, their smallest complaint, you pick up the phone when they call, all of those things matter in terms of building long-term stickiness and value with your customers. And then they tend to give you grace when something maybe happens on occasion, right? They give you grace for that. So to me, it's around that long-term adoption, that long-term stickiness, which then drives ROI for the company.
Excellent. Now, Matt, I have to turn to you because looking on the screens here, your title has an AI in it, okay? And I'm not sure if that's something you ever would thought would happen, but we're seeing that a lot more nowadays. So in that terms of respect, how is AI changing the way you manage money over at Manulife? And I also want to point out, we had an earlier question from the audience too that kind of plays into that. It's how is AI already changing investment opportunities and decision making?
Yeah, I think it gets back to what Sherry was saying about value, right?
Yeah.
When we think of an investment, it is the search for value, kind of uncovering that. And what's surprising for me is how much our investment process has not changed since we embarked on the program. And I think that's because it's investment led. Right? We look at the investment team as our clients, and we're thinking of what do they need. Mm-hmm. So Manulife is a fundamental shop, and in the fundamental process, you're going as deep as you can on companies. So you're looking at financials, you're looking at your notes, your own research notes, you're looking at the sell-side reports. What does it mean to have to integrate all of that? Maybe a coverage launch, you have a little bit more time, but maybe there's a dislocation in the market. And so what we've seen with the way that we're building this is an acceleration, right? The data aggregation, alignment, and sort of discernment process is now assisted with AI. And so we had an example in early April when the U.S. government embarked on the I think Liberation Day.
Liberation Day, yeah.
Right? So we had a semantic search capability in place such that you could look across 6,000 companies or look at even in your own portfolio and see how management was thinking about tariffs in the previous earnings season. And you could think about what would that mean for an analyst to be able to pull that within seconds when it might have taken a week of reading through, maybe 50, 100 company notes in a portfolio. So that's the kind of value we're trying to drive for the investment team, but it is very much being led by the investment team.
So not for decision making per se, or
yeah, we're a fundamental shop, right?
Yeah.
So it's the experience of our investors that is the core of our process, and so that remains the core. It's helping them to get the insights to make that decision. That's where we're really focusing.
And what about the challenges? Because I'm sure starting this and getting to where you are today wasn't easy. I mean, what advice can you offer to the audience out there for maybe a roadblock you hit or something that was a bit challenging and how you navigated through that?
Well, it's interesting because, when I talk to some of my peers at other shops, we just got Microsoft Copilot 3 months ago, and we're working with compliance and risk to figure out what to do with that, right? At Manulife, we've been the Manulife parent company has been investing in AI for almost 10 years. I think it's like something like over $1 billion since 2017. And so when we started to look at AI for the front office, we already inherited all of that. And what does that mean? That means cloud partners. That means relationships with a lot of the foundational model providers. That means we have AI governance, right? So I feel like almost a little bit guilty that we had such a head start. But when it comes to challenges, I think they're similar to what a lot of other shops face. Investment management is a very competitive industry. Mm-hmm. AI innovation is going very fast. What does it mean to be in front of our colleagues in the finance department and putting together a roadmap when the technology is literally going to change completely within the next 3 months? That was a big challenge. What do you do with that? And then the other is, should we even be building this? I mean, we have a lot of wonderful technology partners that are investing heavily in AI. It's not obvious that we would have an edge in that. And what we came to were a couple of principles of our program. One, fiduciary duty has to be at the core, right? That's our responsible AI. Second, it really has to be investment-led. We talked a little bit about that. But I think what's interesting is we opted for the uncertainty. We have a fast prototype framework where we work directly with the investment teams. We try to deliver value pretty immediately, within a couple days or a week, with a prototype. And then we're willing to let these prototypes fall if they're not sufficient, or we scale them up into production once they've kind of proven their case. In terms of whether or not we should build, I think that really gets back to what would you do with that? And I think in terms of data sources, right, analysts might have 7, 8 platforms that they're trying to integrate data from, their own research notes. And so we think of that workflow integration as key. And that's a very good reason to build internally. A second is we can select models. It's hard for a vendor that has 100,000, 200,000 customers to really pick a model that is cost effective at the scale that they need. If we have 1,000, 2,000 internal investors that we're serving, we really can select a model that will provide the best value. And finally, the proprietary data. We like to keep it in the circle of trust in-house. So that's been a big part of it.
It's definitely a lot to take in. So listening to playing off of what Matt said, I know Workday uses AI as well a lot. And we were speaking earlier, and I know you were describing it as kind of this sous chef, right? I know my daughter's best movie is Ratatouille, so this is why I bring it up. Yeah. But how is AI working for Workday? And talk about some of the success stories, and then I want to get into maybe some of the challenges too.
Yeah, so maybe just within my functions.
Sure.
So largely my teams are all the delivery functions. So if you think about professional services, support, education, kind of all the paid service offerings, it is our sous chef. I like to think it brings the best recipe together, right, all the right ingredients, much to what you said, to really allow them to kind of take the best action with the customer and free up their time to innovate and drive different changes. So for us, it's about driving innovation with our customers and not having to do a lot of the blocking and tackling. And hopefully AI can provide a lot of that, those ingredients so that we can jump right to the innovation. So when we think about innovating with our customers, Instacart's a great example. So we were able to innovate on the platform with our Extend products, which basically allows them to customize to an extent some of what they do with Workday, and they built like an amazing performance application that saved their teams a significant amount of time. Or if I think about HPE, they leverage Workday from a skills and talents perspective, so the AI we have within our products. And that's allowing their teams to be much more effective in internal mobility and how they retain their talent. So it's just a game changer when it comes to really that enablement and kind of driving it forward.
Now, what are some of the not so great moments that you had to kind of be faced with, and how did you handle that?
Yeah, and I think it hits on Matt's point. So sure. It's less about the technology being, the failure point. It's more about the change management and the governance. We did some research that basically showed, 62% of business stakeholders feel like AI is going to provide value. in a governed and trusted way. And that leaves 38% that don't feel confident. And so it's really about working with our customers to make sure that they feel that AI is responsible. We have the right fact sheets, They understand kind of the data sources it's pulling from to drive that confidence with them. So it's really bridging that is where the focus is.
And so we kind of touching upon this, the concern with AI risk or bias. And I know that's something that we've talked about, Matt, the risk of bias. Do you trust the information? Do you trust that your employees are using the technology the way that they should be? So how do you handle that, or how are you adjusting to that over at Manulife?
I have a lot of trust issues.
That's another type of chair talk.
Just get lay down a little bit.
Yeah.
And I think that's the right way to look at it. So when we're deploying technology, we look for partners who they can look at something and know whether it's right or wrong.
Okay.
Right. We had a great experience with our head of European fixed income trading, and he was working on a report, and something looked a little off. It was an early prototype. He was able to get that feedback to us, and we were able to enhance the guardrails there, right? And so when we're thinking of this, we're not trusting the technology, we're trusting the humans to use the technology responsibly, right? And that's really at the center of Manulife's broader AI principles for responsible development. And in thinking about, investments is a heavily regulated industry, we're very fortunate to have risk and compliance partners who were willing to meet with us when this was a very early stage working with interns kind of project. When we were just sort of initial explorations, we were able to meet with partners in risk and compliance and embed that in every stage. And so now as we're scaling our solutions to the investment teams, that's embedded in the products, and then we have monitoring in place to ensure that we're using things responsibly, and so we can better serve the clients, right? The investors that are part of our team. I think that's how we're thinking of it.
Now, how about for Sherry, when we spoke earlier, you said something kind of along the lines when we talked about technology, and you said the most advanced technology won't drive long-term returns without a foundation of trust. Yeah. So talk about that foundation of trust. Dig a little bit into that for us.
Yeah, so we strongly feel, and I strongly feel that trust is like the ultimate currency, right? That's what's going to, per my conversation earlier, to really build that long-term foundation with the customer that you can kind of rely on with our core values. But if I think about it, it really comes in probably three ways. One, we want to really create an open platform for our customers to talk to each other, to talk to us, to talk to, so that they're hearing best practice. They can, check, I always get asked, is this the best practice? Am I following it? So we want to make sure we have open platforms. And we use AI to make sure, right, that we're gaining all of the knowledge across all of those open platforms to make sure we're improving our data sets, et cetera. But we also want to make sure that we're advisors. So it comes back to understanding the problem we're solving for, and the technology is not going to be solving the right thing or bring the right return if we don't understand kind of what's the strategic question we're answering when it comes to the problem. So putting that all in context is critical to those relationships. And if I look at Salesforce, we just implemented a big finance platform for them through Workday, but it came through co-innovation and understanding what their business needs were around how do they pull all of these financial sources, given all the acquisitions they've done, right, and all of the changes that they've overcome, but really listening to them, building that trust, right, and then co-innovating together to make sure that they could bring all of that to do more, hopefully faster month-end close, quarter-end close, right, all the things that become critical in your business processes. So those relationships are key, and those kind of value points, I think, on a continuous basis.
So going basically beyond just a vendor, like a trusted partner, and having that like human-centric approach to it. Okay, so let's talk about the enormous spend on AI, because there's a lot of talk about it and when it will pay off. So how do you approach that question if you're asked that, Matt? Because I know there's a big spend amount, and how do you justify?
Yeah, that's the big one, right?
Yes.
I think it's something we think a lot about, but the reality is, from my point of view, in the investment field, that spend is a strategic investment. I don't think we can think of it in terms of a technology expense. And I mean, $1 billion since 2017 is a pretty solid foundation for us to kind of extend to the front office teams, right? So when we're thinking of spend, you have to have a certain level of certainty about the future, right? There's typically a capital budgeting framework where you're looking at a project, the cost, the benefits. There has to be some kind of ROI, some kind of NPV with that. And how do you do that if, I mean, no 5-year-old says, I want to grow up to be the head of investment AI, right? Like it just wasn't in the cards.
Here we are.
Here we are. And the technology is literally changing. I mean, it's hard for me to say what's going to happen in 3 months. So I think that's the central tension that we have to think about when it comes to spend. Not so much are we spending too much and not getting enough, but how do we struggle with that certainty that we need to kind of assume to allocate capital, and the uncertainty from the speed of innovation in AI, the hyper-competitive nature of the investment business. And I think our answer was this fast prototype framework. It seemed like a responsible way to minimize the risk. And that's not to say we don't scale that up, but we scale up the things that are landing with the investment teams. And when it comes to that spend, we're not thinking in terms of efficiency of the investment process, right? This is not it's not a cost center, right? We have a fiduciary obligation to our clients. And if there are tools in the market that give us an edge, that can help us accelerate that step from data to analysis to insight, if we can compress that time, that's going to be table stakes. I think we have a credible claim that what we've done very well is listen to the investment team rather than kind of come in and dictate, here's how you should work and here's what you can do. And I think I might have slightly dodged the question.
You're good at that.
But I tried to do so in an honest way.
No, but it is. I mean, these are questions that are being asked, and there's a certain way to handle these certain questions, whether you go around them. Is the
But speed is a strategy,
Yes.
right? And that's basically
Thank
what
you,
you lay
Sherry.
out, right?
Write that
Sherry.
down.
Yeah.
Well, speaking of it, Sherry, so in the different positions you've held, what's some of the misconceptions that people may have or leaders may have about technology and the investment in technology?
Yeah, so I think a big one is technology to just kind of shoot for the next shiny object. And it's really not about understanding, again, just the technology. It's understanding those problems we're solving for and how do you really create clarity for strategic clarity for when you should make that investment because it's solving a problem. And maybe it's, some people will say, well, it's a problem you didn't know you had. Well, I'm not sure if that's entirely true, right? Because there are problems to solve and it's just different ways to get to that means. And so being super thoughtful about that, and then also not forgetting the human element to your comments earlier, Lisa. Right, it's not just about the tech, but how do you change the adoption strategy? How do you change the change management? Like, how do you bring those together so you're reaching the outcome that you intended? So that coupling is super important.
Now, as we start to wind down, we're kind of take a look ahead. What emerging technologies are you keeping an eye on? Because there was a question from the audience earlier. How will agentic AI tool use affect the investment landscape?
Oh, I'm quite excited about that. Cause,
I know you do get very excited about it.
Yeah.
Go ahead.
So if we think about a lot of the work we've done, it's been with qualitative data, right? Yeah. LLMs are fantastic at text processing. I'm sort of a reformed quant. We're very much in the numeric space.
Okay.
And LLMs struggle with that, right? We've seen how many R's are in strawberry. The models have gotten better since then for sure. But with agentic, we unlock this capability to integrate the quantitative and qualitative, which has kind of been the holy grail of investing since, for quite a long time, I guess. And so I think with agentic, and we're prototyping this now, it's the chance to be able to break complex tasks into simple parts, right? So you could ask an analyst, compare CapEx of these 4 companies with the revenue of this other company. You have to have an agent that understands what CapEx is, that can source the data, that can validate the data, that can understand what you mean by compare. Is that a regression? Is that a correlation? And then render that data, like do the actual regression or correlation, maybe chart it. That's kind of what the power of agentic is going to unlock. So the data security is obviously the question that's kind of hovering in the background, and we're thinking a lot about that as well.
There's a lot to look forward to. That's what keeps you up at night. I know that. And Sherry, where do you see Workday, let's say looking 10 years ahead or now? How is Workday kind of planning for the future?
Yeah. I don't know about 10 years. That's
5,
a long
10,
time.
yes.
But, I would say in the next few years, I mean, AI is going to be a force multiplier in terms of the speed at which we can operate, right? The value we can bring, and really the personalization that we can do for customers. I mean, it's almost like the technology fades a little bit into the background. I mean, it's foundational to where we're going to get, right, and where we'll continue to be. But then it's really about those human connected experiences that you build on top of that. So it's going to be so important, right, that we really understand that kind of how we're bringing those to bear within the experience, within the products that we have, right, and how those will drive the future.
Excellent. All right. We're going to have to leave it there. Thank you very much, everyone.
Thanks, Lisa.
I'm here with Tim McLaughlin from Invesco QQQ, and I believe you're out of Chicago.
I am.
So welcome to LA in this amazing weather that we don't get to see sitting in here, but
That's for certain. It's a far cry from the Midwest, that's for sure, but it's a nice change.
yeah. So why don't we start with a quick reminder of what Invesco QQQ actually is?
Sure thing. So Invesco QQQ is designed to track the NASDAQ 100 index, and the NASDAQ 100 index is comprised of the 100 largest non-financial stocks, or companies rather, listed on the NASDAQ stock exchange. We think the resulting portfolio exposure is one that really provides access to innovation for end investors in a single ticker solution. You know, NASDAQ, or QQQ has a 26-plus year track record, so launched in 1999. So I think you could argue that it's innovative in itself, having been launched in really the nascent stages of the ETF industry, which I'm sure many in the room know is grown in a substantial manner. By assets, QQQ is currently ranked 5th overall as far as AUM is concerned globally, and it is the 2nd most actively traded ETF. So.
Yeah. Yeah, it's become one of the largest, obviously in the U.S. When we first started working with Invesco, and we have had a long relationship with you, so thank you. I did a deep dive just to understand, like, where did the Qs come from? Do you know that answer?
You know, enlighten me.
So NASDAQ, when they created it, gave it the QQQ because a lot of the NASDAQ stocks ended in Qs, and so it was just sort of a ticker. It was the ticker that was used to trade it. And then Invesco recognized the power because traders began just calling it the Qs, and they recognized the power of that brand, and that became why it's known as the QQQs. So
here we are. We learn something every day, right?
It was a brilliant kind of almost accidental marketing. It wasn't a marketing move. But it was accidental in the sense that it became this powerful brand.
Absolutely.
So, anyway, in today's changing environment, which I think we all know is one that is quite active and changing. When Lisa said, where do you see things in 10 years? We were talking like, where do we see things in 5 months? So in today's rapidly changing economy, how are the holdings within QQQ adapting, evolving, changing?
Yeah, so when we think about innovation at Invesco, we think primarily from a lens of research and development. So, and research and development spend of the underlying companies within Invesco QQQ. So what we've found is that QQQ companies have a tendency to spend more in research and development when compared to other companies in the S&P 500.
Yeah.
So if you were to look at a headline index level, I think it's roughly 1.4 times the amount of spend on average that's spent by a QQQ company relative to an S&P 500. Further, if you were to strip out the 85 or 86 names that also fall within the S&P 500, that spread goes up to almost 12.5x. So that has really been the kind of fuel that has given these companies the ability to be successful and stay ahead of changing consumer preferences and different trends. I think the other aspect is really they've been able to be nimble. Good example of that is a lot of the Mag 7 companies that we see that have been driving a large part of performance for overall equity indexes. In the last few years, they've looked very different than they did maybe 20 years ago, right? So they've diversified their core business structures and segments and really just been able to actively reinvest and stay current.
So when it comes to investing in emerging technologies, where is QQQ looking outside of the technology sector per se?
Well, one of the biggest misconceptions that we come across at Invesco is QQQ is a tech fund, right?
Right.
And to a degree, that's correct. You have a significant exposure within the portfolio that's tech, roughly 65% or 55%, depending on the classification system you're using. But
which is down from what it used to be when it first started, right?
Yeah, it changed. It ebbs and flows.
Right.
But what we've seen is, you still have a sizable allocation towards telecommunications as well as consumer discretionary.
Right.
And if you look at the patent portfolios of these companies, you see a lot of, if you look at the main disruptive areas within the industry as far as tech is concerned, right, and even more broadly, you see a lot of the AI things as far as big data, natural language processing, but the exposure within the portfolio specific to healthcare is something that's differentiated. So you think bioinformatics, robotic surgery,
right,
nanotechnology. So it's something that we think is a diversifier within that portfolio, and leads it to being really a good option as far as someone looking to get large cap growth exposure in a portfolio, or even satellite exposure where they want to access that innovation and different kind of technologies and budding industries that are really encompassed within the broader wrapper.
Yeah, when I was looking at the portfolio and how it's changed, it seemed to me that Invesco QQQ is really looking for these transformative themes. Mm-hmm. So, in the case that you're talking about here, how technology will transform healthcare, for example.
Absolutely, and I think
mobile payments.
That's another great example, and I think just the day and age we're in, right? Technology really. It's a gray area, because if you're in the financial services industry or if you're in healthcare, pick your poison. You really need to be able to adopt technology to be successful in your own business and grow results. And the companies that are doing that well are the ones that will be successful and have been successful.
Right. Well, thanks very much.
Thank you, Mark.
Yeah.
Hi, everyone. I'm Mark Gurman from Bloomberg News. I lead our consumer tech team. I'm here with Durga Maladi. He is one of the top executives at Qualcomm. He runs their AI strategy, data center strategy, and as he likes to say, he's involved from everything from rings to phones to desktops, and so he has his mind and hands in probably all the gadgets you have in your house, in your bags, in your pockets, or in your hands.
Yes.
Why don't you tell us about Qualcomm? Because I think it's really a behind-the-scenes company, because you don't sell a consumer product, but you're in all of them. Tell us about Qualcomm and exactly what you do there.
Qualcomm has gone through, so we just celebrated our 40th year anniversary, and I've been through 28 of those 40 years. So every few years or so, we have like a DNA mutation, and at this point in time, I think the way to think of Qualcomm is we provide all the solutions that power the devices that you carry around with yourself, going from doorbells to data centers now, as I'm talking of. So the way to capture all of this is intelligent connectivity. And the reason why we actually specifically mentioned that, it might be an often repeated phrase, but our origins were in wireless communication, so we maintain the connectivity, but increasingly we bring in high performance but energy efficient computing into devices that you and I can carry around with us. And that's kind of critical, because what we have seen is that the learnings that we have from devices in energy efficient computing are equally relevant in data centers these days as we start paying attention to the overall, the grid implications and the energy implications of that. So, and maybe just a word or two on the devices by itself. When we talk of energy efficient computing, the computing can be broken down into three categories. There's general purpose compute, that's the CPU that actually runs all the efficient, the processing that we do. But it has some applications to AI, but not necessarily all of it. And then we have the GPU, which is it has a day job of graphics and all the other rendering that we do. But our processor focus when it comes to generative AI is on the NPU. The NPU is designed from ground up specifically for generative AI workloads. And so based upon that, today, if you take a typical premium tier smartphone, you can run a pretty large model on it, like a 10 billion parameter model on it. Just to put this in perspective, November of 2022, just short of 3 years back, is when the ChatGPT moment happened. That's the time that all of us actually started paying attention. At least in the mainstream, more people paid attention to generative AI. But the 10 billion parameter model that you have today easily outperforms those models from back then. Bottom line, we are at a point where we can run pretty compelling generative AI use cases and very large models and devices. Today, whatever could run in the cloud last year, for instance, you are in a position to actually run that in devices now. So smartphones, PCs, glasses, AR glasses, and consumer and industrial IoT. Consumer IoT goes into wearables and automotive. These are like the broad category of devices that we talk of.
So first things first, today a lot of us carry a phone in our pocket, maybe we have a tablet, maybe we've got a laptop. I'm wearing a smart ring, wearing a smart watch. What is the consumer, not the, early adopter consumer like me, but, the mainstream, 3 years from now, what are you carrying?
Okay, so there's a lot that's going on, but maybe I'll preface it with what is it that we want in the devices around us? We call this as the universe of devices. By the way, as humans, we've kind of made our choices in some of these devices. You correctly pointed out, we wear our glasses, we don't carry them with us. We wear our rings and wearables, which is watches. And then the notion is that, okay, and then we carry our phone with us. We don't wear our phone with us. It's a slightly different perspective. But we are in the business of connectivity and intelligence together in all the devices. Our watches are, by all means, connected directly to the network. You can actually have that. So if I were to actually pick just one concept, that would be glasses that you wear, which are directly connected to the network.
So let's pause for a second. So I have these here. These are the Meta Ray-Ban display glasses. These just launched a few days ago. If you want a pair, good luck finding one. But what's unique about these is they're one of the first mainstream smart glasses with a display. So I have this neural wristband here, and you can do hand movements and what have you to control these things. And they have a screen in it, so you can see who's calling, you can do video conferencing, notifications. And, I look a little odd wearing them. I just actually took a picture of all of you. But they're kind of nifty. So, Durga, what's your role in these?
So it's our chip that actually powers these glasses.
You're inside of these. They only work because of what you guys developed.
That's right. And if you kind of think about it, by the way, I mean, I can go all pretty geeky into the tech over there, but just think about what we are talking of there. You just said you took a picture. There's an actual camera in there, and there's like a, you can make voice calls, you can do lots of things with it, which are kind of, just a few years back, it was not easily to foresee. And these are glasses that you basically walk into a store and buy. These are not pretty goofy glasses or anything of that sort. The form factor is really slick. And now if you think about, once you add even the direct connectivity directly to the network, as we talk through it, and this might be very well the beginnings of the 6G era in some sense. Every G has a way of defining the defining device in that sense. It is possible that this could be one of those devices. At least that's what we are actually focused on. But that actually brings in a completely different perspective, because what you can do now is run some of the AI processing in the glasses, and the rest of it can be run somewhere in the cloud, all the way into the data center, or maybe somewhere at the edge of the network. It's distributed processing that occurs. And that's a very different kind of a world that we're going to live in. Now, given that you actually showed your device, I'm going to show one other one.
Oh.
This is, last week we had our Snapdragon Summit. It's something that we do in terms of, and we talked about a latest generation of PCs.
And it's in Hawaii.
It's in Hawaii. It's a tough life, but, someone's got to do it. So it's very well attended, and we actually did it in 2 locations concurrently, both in Hawaii and in China at the same time. But we talked about the latest generation of Snapdragon processors and the platforms for PCs and smartphones. This, by the way, is a full-fledged PC. This is what, if you think of a Dell or a HP or a Lenovo or a Microsoft laptop, this has the complete processing power in that. Now, if Microsoft is a very close partner of ours, just like Meta, and so are Dell, HP, and Lenovo. But as we start interacting with devices like this, one of the things that you might have noticed in the glasses, and I think it's far more stark in that, is every few decades, there's a change in the UI between a human and a processing capable, something that's a processor in front of you. I wasn't there in the 70s when we were talking about this, but the 70s was mainframe, command line interface. That's what it was all about. Sometime in the 80s, that's when my first introduction to all of us, quite a few of us at least, to a mouse, something more graphical. That's a change in the UI. It's very different from just a command line interface. A couple of decades later, we all got used to a device in which touch became a far more interesting interface. And then now, today, we all carry around devices with a clutter of apps in that. But you know what? You don't actually do that with it. You use your voice as the UI a lot more. So in some sense, AI is in fact not only changing the UI, but is the new UI to the devices over here. I would like to talk to my laptop a lot more than actually search for things or do some things with it. And so that's something that, as Qualcomm, we are investing in quite heavily. How do we make it easy for all our partners to build solutions on top of it?
So I think from an investor standpoint, people want to know what's going to happen to the phone. What's the impact going to be on these phone companies like Apple? What do you think?
My personal prediction on that is the phones are here to stay. I think they are here to stay. It's the way that we interact with them that is going to gradually evolve. It's an evolution, because most of the times what happens is that when you have a fairly mature device, unless you have like a full-fledged replication of that, there's not going to be like an abrupt transition. It's going to be a gradual transition. But the real innovation starts coming in from devices that didn't exist before, like the glasses that you just showed. That's where it's like a clean start. You can actually start with whatever and then you bring in something new. So we think of it as an evolution in the smartphone and a far more revolutionary approach when it comes to new kinds of devices like that.
And to your point, the phone, right, didn't kill the laptop. I mean, maybe there's some people who don't have a laptop now because they have a big phone. The tablet, everyone thought the iPad would come in and destroy the laptop, but that didn't happen. Laptops are as ubiquitous as ever, if not more so. What is Qualcomm's role in the laptop today? Because really you were known initially with cellular connectivity, and then you have done phone chips, but more recently you're going big in PCs.
That is correct. So maybe I'll spend a few minutes on what we are doing in PCs. So together with a close partner of ours, Microsoft, and all the other OEMs who are involved in this. Last year, you saw the birth of what was deemed as AI PCs. It's the first time that we started talking of AI integrated into the PCs, into laptops, in a way that you can run pretty large models and use cases, AI use cases, directly on the device with or without connectivity. And most of the laptops don't actually have cellular connectivity. So this is even in instances where you're literally in an airplane mode and you're still getting some work done. And the AI PCs, starting from June of last year, it coincided with Microsoft pushing very strongly on the Copilot features. So these days, by the way, there's lots of nice features that are there, where you enter a Teams meeting, and then if you join in like a few minutes late, you actually get a summary. You can ask for a summary and get done with that. But there's a lot more. At the end of the day, the laptop is something that it's a bread and butter for code generation, software, content creation, and things of that sort. And AI is permeating all of those things. Like generation of code these days in enterprises, a good fraction of it is, there is dependence upon AI in one form or the other. At least that's emerging trends. And as Qualcomm, what we did is make sure that these PCs can run very energy efficient, but pretty large models running directly on the platform itself. This is slightly different from what runs on the data center, in the sense that when you have large models in the data center, when you talk of a rack in a data center, that's like 150 kilowatts, right? And think of what actually powers your laptop, and you want it to last for 24 hours. So our stringent KPIs were extremely power efficient but high performance CPU, the ability for our NPU for AI processing to run at a very low power but very large models. And there's always a balancing act there between the processing capability, the compute capability, and the actual memory footprint. There's always a balancing act. Sometimes you tend to be more memory bound than compute bound. But bottom line is, we feel like we've kind of reignited. Like today, when we think of laptops now, it's in a different way. It's not what it was even 5 years back. A lot of things have changed quite dramatically in that space. So we're in the business of providing all those computing solutions that go inside, not to mention the software stack that comes with it, to make it easy for developers to build use cases and applications on top. That's a software stack, making it more convenient and more easy, and of course, working closely with the Windows team.
So I'm just thinking about this. Think about all the companies that we work with today or use their applications today, companies like Uber or Instagram, Snapchat. These are multi-$100 billion, trillion-dollar companies. AI is really going to change the need for these companies. You're going to see apps starting to go away. You're going to probably see the app economy be thrown in the air at some point. And there's trillions of dollars at stake here because of AI. I'm curious what you think, how these companies are going to need to evolve.
I think AI has emerged, whether whatever you believe in it or not. I'm a big believer in AI, but it is here to stay, and it is certainly very disruptive in lots of things. The last time we saw something like this was probably at the birth of the smartphone, and before that, the birth of the wireline internet in the early 90s. It's one of those moments. So clearly, there's lots of opportunities coming in. When it comes to the apps, as you mentioned, we didn't speak a whole lot about agents, but there is a trend towards applications. At the end of the day, they all live in their own individual silos. Like if I open one app and then I open a different app, they don't actually, strictly speaking, communicate with each other. And that is not how we as humans think. Sometimes we might want to do like some multitasking with 3 or 4 things put together. I want to buy something, but at the same time, I'm just checking whether I have enough in the bank balance, and then meanwhile go from there to a travel app. The idea of an agentic workflow is something that sits above apps, perhaps being the front end of the app, so that when we talked about AI as the new UI, your first interface is actually to an agent and not to the application. And what that means is that it's a pretty complex task that you explain in a very natural language, and it's the agent's job to figure out what to do from there onwards. Pick from a rich bouquet of AI models to figure out which one is more relevant for that task at that point in time. Interface with some sort of a personal knowledge graph that's residing either in the device or somewhere else, but tap into it to get a sense of your preferences, and then use that information to see, okay, which apps do I need to process all of this and get back with that information. And so agents, the way we see it, are increasingly becoming more prominent and as the front end towards the users. What does it mean for apps? The apps still exist, and there might be a period of time of coexistence between the both, but increasingly there's a lot of interest in building agents which can actually, and by the way, there's not just one agent. You might have several agents. In your device, you might have like an enterprise agent, a medical agent, and things of that sort. And you can take it to one more extreme. Next time you open up, I'm just making this up, but next time you open up a specific spreadsheet and so on, you might actually open up a financial agent, which then goes through all the financial things. But that's where the specialization is. So there's lots of opportunity over there. What it means for apps, I think it's to be seen. I don't have a good, clear answer on that. It's always hard to predict the future, in our industry at least. And but what's clear is that agents are clearly taking over as a level above the apps at this point in time.
But here's the big problem. We have the underlying hardware technologies from companies like Qualcomm that are building these things. We have the underlying AI technologies from companies like OpenAI, Anthropic, building these technologies and the ability to build these agents. But then we have this duopoly of operating systems that are conduit to these devices across the world. You have Android and iOS. But neither Android or iOS, Android to more extent, are implementing this new user interface that feels inevitable. So how do we get there if these companies want to sort of control that moat and keep the app ecosystem alive when it's pretty clear this underlying technology is popping through from below?
I mean, just to be very clear, you forgot to mention Windows, by the way. But
Windows, yeah. Who uses that? Right?
We, as Qualcomm, Microsoft and Google, very close partners of ours. So we actually work closely with them in terms of going through. Yes, it is true that if you were to actually unpack that a little bit further, these days when we think of AI and if you think of models, AI models are actually coming in from all over the place. And not necessarily just from, you picked some names like OpenAI's obviously GPT-5, and most recently they even announced the GPT OS's 20 and 120 billion parameter models in open source out there. It's a new trend. But then, and then we have Anthropic, we have a few other model creators. But it's also important to understand that model creators exist all over the world. We actually work very closely with the model creators very recently, and you'll see us talking a little bit more about that, but both in the Middle East, in Japan, in India, and most certainly in China, there's a lot of other model creators who are in that language, but they also have a different way of actually looking at things. So model creators are coming up independently of everyone who has the existing OSs. And then there are certain devices where actually it's none of these OSs. In fact, Linux, open source Linux is actually used quite a bit. So it's very interesting times to see how this is going to evolve. Our take is that at the end of the day, all of our partners are very eager to bring in rich user experiences based upon what they have. And we are in an ecosystem where if you start seeing far more compelling use cases coming in from elsewhere, everyone tries to catch up over there. So personally, I'm not too worried about that one. Really looking forward to seeing all these use cases that I talked about come in.
So if you think about going back to hardware, going back to the devices, right? Like my arms are getting kind of filled up, my pockets are filled up. I mean, something's got to give, right? People don't want to charge 7, 8, 9 things every night. Maybe you don't have enough outlets or desire to do that. What's going to win out?
That's a tough one. The one thing that we definitely want to do is make sure that they all coexist and work in conjunction with each other. And does it mean that you have like a single vertical ecosystem? Not necessarily. There are protocols that are emerging right now in which devices can communicate with each other in the right way. You are right about one thing that we talked in the beginning, which is there's a lot of things that we wear with us, and those things are kind of taken. Now, maybe there is still some room for a pendant tomorrow. I don't know.
Did you see this thing called the Friend? Has anyone seen that? It's a necklace, and it's like an AI that you just wear on a necklace. It's kind of ridiculous.
We've seen one instance of this like a couple of years back, but I like the fact that there's a lot of experimentation going in that space. I mean, we wouldn't be here with that sort of a device with the AR glasses unless we keep experimenting. But those devices will continue to happen. Now, in terms of what else you can carry with us, well, of course, we have a smartphone, but it remains to be seen what's the appetite for us to carry even more devices in addition to a phone, a laptop, and maybe another puck or something like that. But yeah, there is probably a threshold over there. But we think of it as the universe of devices that we have chosen for ourselves. And just from us, we want to be the ones powering all of those platforms.
Well, maybe next time I'll be wearing an AI T-shirt. So, anyways, thank you, Durga.
All right, thanks. Thanks for having me.
For staying with us through the last panel. Every cycle leaves its own mark. It's a story of excess, correction, renewal. Yet this time feels a little bit different, right? Inflation fought back harder than expected. Policymakers blinked a little later than usual. And as if macro uncertainty wasn't enough, we had DeepSeek put the whole AI hype to test. And after all of that, markets still refuse to blink. So now we stand at very interesting crossroads where we are having growth without clarity, liquidity without comfort, and opportunity without consensus. And the question is not really where to invest now, but also what kind of an investor does this situation demand? And today our panel will delve right into that debate and that tension across equities that defy gravity, bonds that are just coming back to life, and private markets that are rewriting the rules of value creation. Please join me in welcoming Samantha, Scotty, and Alex. Thank you so much for joining us today. So we got a lot of questions from you all. And that's why we have all of them to answer those. Let's start with the audience question. Given the heightened uncertainty in 2025 with geopolitical unrest, political change, persistent inflation, how should investors think about positioning across asset classes? It's basically the holy grail. So Samantha, let's start with you. I mean, you look at across asset classes. How are you recommending positioning for investors now?
Cautiously. There's so many risks in the world right now that you just have to know exactly what's in your portfolio and why you own it, and if something goes wrong, what are you going to do with it? And that's for each and every asset that you own. It could be a bond, it could be a stock, it could be an index, it could be a private asset. You just have to know what you own. That's one of the biggest things, biggest things that you have to understand right now. I mean, as you said, equity markets have been defying, logic and going up and up and up. The bond market is, in a state of tension, I would say. And private assets are, mostly valued every quarter. So there's a lot of different things, levers to play with within your assets and within your portfolios.
Absolutely. So, Scotty, given persistent inflation, what business models and investments are you seeing which are promising a little bit more at maintaining real returns, like not just following the nominal growth? Like, do you have any ideas or themes that you're observing on your end?
Yeah, I wouldn't necessarily say a specific sector. I think it's really important to look at the specific business models of any company that you're looking at. So things like, is it a leader in their space? Do they have strong pricing power? Do they have contractual nature of their revenue that's got some built-in escalators? Things that are going to be asset light might be a little bit less sensitive to certain things. That being said, if their revenue is driven by things that might benefit from an inflation, perhaps there's a natural hedge that goes on there. So I think really digging into the fundamentals of the business model is more important, quite frankly. Certainly you can look at sectors from what's benefiting from secular trends, what should have more durability. That's going to be important in any cycle. I would just say the flip side of that, right now in an environment that's this dynamic, especially, smaller business that may not have as much vertical integration if they make a product, may not have as much control over their supply chains, that's probably going to be higher risk in an environment like this. So probably things erring to the benefit of the leaders of a given sector is probably going to be more true at this moment.
That makes sense. So basically going back to the drawing board, focus on fundamentals. Alex? Wealthfront's business is built around the concept of the passive investing concept, right? Can you share a little bit more about the key strategies that you're recommending your investors or customers?
Sure. Well, we're big believers in passive because beating the market is really, really hard. And we see this in data year after year after year. We quote the SPIVA studies almost every year. And the most recent one showed that over the past 10 years, about 90% of active U.S. equity managers did not beat the market. So that's one of the things, one of the reasons we believe so much in passive. The other kind of core tenets that we believe in are diversification, low costs, and staying tax efficient. So our advice to investors, especially individual investors, now is kind of the same as it always is, which is kind of boring, I'm sorry. But it's build yourself a portfolio of low-cost index tracking ETFs that's a good match for both your goals and the timeline of those goals and your kind of psychological or subjective ability to take risks. We want you to have a portfolio that lets you sleep at night, because one of the ways that investors hurt themselves the most is by getting spooked when markets go down and selling low and then buying back high when the markets are on the rebound.
That's music to a lot of ears, I presume, right? What sectors outside of artificial intelligence are kind of coming up on your radar? Maybe we can let's start with Sam. Any alternative ideas? I mean, all of us are obviously big on AI, and the event kind of echoes that fact as well, but what else?
So there are other things besides AI out there, obviously. So a couple, on my hit list right now are, especially within the private markets, are defense technology. So, thinking about the defense systems of tomorrow and how do we fund them today. It could be something like a missile system. It could be something like a drone operator. It could be cyber tech. All of that is going to be super important. FinTech, obviously AI is revolutionizing that as well. But there's plenty to do within FinTech in terms of payments, in terms of modernization, stable coins. One of my favorite podcasts is the Money Stuff podcast. And I just love hearing about stable coins there. And it's fantastic. And then I think the last part is, one of the last sectors is really agriculture and ag tech. There's so much to be done in terms of the food that we eat, the way that we harvest food and grow food, and how that is transported around the world. That's a really ripe area for investment as well.
So thank you for bringing that up, by the way. For those of you who don't know, I actually cover FinTech. That's my space. But we've also done a lot of work around stablecoins and definitely a lot more interest around that now and this year. Scotty, any other themes that you'd flag?
Yeah, I think sports is another one. You're seeing now much more opening in terms of private markets and institutional firms being able to invest in the sports ecosystem. So you've seen, a number of firms, including ourselves, who have recently launched larger strategies to focus on that. So I think you'll continue to see, good kind of private partnerships in that area. And it's just a very durable area of investment that there just hasn't been as much access to historically in that regard. And I would say, otherwise, I think you touched on really a bunch of the major themes. The only thing, again, going back to is it AI or is it not AI? I think, especially for us as a firm, because we don't tend to focus on the stuff that's necessarily the earlier stage, actual, potentially like AI, LLM type businesses, but lots of other parts of the ecosystem, infrastructure plays, the power grid, all of the, parts of the system that are going to have to, be significantly invested in order to support that incremental demand that, data centers are going to create, I think is an interesting way to play it that's not as on the nose.
That's a very good one. So I wonder if this term has already been coined, but maybe we can call it the AI bleed. Like whatever AI goes, touches, changes, that's the space that we can kind of start looking at.
Except it's scary for all of our individual power bills, but.
We'll definitely come back to that. But Alex, from your perspective, you also wear the hat of customer data analytics, right? So can you share any insights that you have learned by just seeing what people are doing on your platform?
Sure. So over the past few years, we've allowed more control and granularity in our clients' portfolios. In 2021, we started letting our clients build portfolios of ETFs, which we would then manage using the same technology that we use for our Wealthfront build portfolios. A couple of years ago, we also let clients start buying into individual stocks and ETFs, or they can build portfolios of individual stocks that they can just buy with a click. And a couple of interesting trends. So both of those things have been a good source of data for us. One thing that we've seen is people want to take more risk. pretty consistently, whether that means just deleting bonds from the portfolio or concentrating into U.S. assets. There's definitely a trend towards more risk.
Chasing returns, you mean?
Yeah. The U.S.-centric portfolios have kind of that trend has kind of slowed down this year, and we saw a pretty sharp increase in allocations to pure Europe. So there's definitely some returns chasing going on. One interesting thing in the stock investment or individual ETF investment, we saw a lot of people just holding ETFs, VOO, QQQ. And that actually informed part of our strategy to invest more into our direct indexing offering. And then the last kind of interesting sort of idiosyncratic thing is a lot of people are interested in passive income. I think generally, but also in their investments.
And that's across generations?
Across generations, but surprisingly, it's actually the youngest generations that seem most interested in it, which is a little counterintuitive to me. They still want to invest for growth, but they want to set aside a bucket, I guess, that generates income and helps, give them some more spending money.
That's interesting. And I think that probably also kind of reflects on the interest rate environment. We've been in higher for longer kind of regime. So
past couple of years, you can do that. A couple of years before that wasn't much.
Yeah, exactly. Actually, I'd be remiss if we don't talk about risks in this environment, right? There are some common concerns around CapEx investments in AI and what happens if and when the market focus kind of shifts away from everything is so amazing and AI is going to change the way we live to hold on, what's the ROI on these investments, right? And that exacerbated by a slowing macroeconomic environment, sticky inflation, potentially weakening labor market. What does that mean, right? And then we have industrials and energy multiples have expanded, and people are wondering, is that also like a sneaky AI trade? Like correlations between tech and energy are so high now. So I think it's important to kind of think about what risks to kind of be mindful of, right? Samantha, what are some of the things that you are kind of watching very carefully going into 2026?
Too many to name. But on the private side and within hedge funds and alts as well, I think there's a lot of the dearth of distributions that have come from private fund managers is incredibly, incredibly challenging for limited partners right now. If I look back at a pacing model of what I thought the capital calls would have been for a fund that's about 5 years old, we're at about half the DPI that I would have expected just from natural, cash flows off of a fund. And you think about that across all the funds in your portfolio, that's incredibly detrimental for what you can make and pace into future investments within privates. So I think that's risk number one. The second risk is really just the IPO market. In order to have generational wealth transfer within the venture space, you need these generational returns that come, every 10 to 15 to 20 years within the venture market. And that has traditionally come from companies going public, and that has not happened yet.
Well, I'm not going to complain about that because we had quite a few companies, Klarna, Chime, Circle, at least in my space, Galaxy, Toro, we've seen some unlock, but do you think is the market really open?
It's not open. It's getting better, but it's not where, we had expected it to be at the beginning of this year. And obviously that is coming off of the dearth of distributions on the private side. This special problem within venture is the IPO market, which really has not opened yet.
Scotty, you work with a lot of companies pre-IPO. What type of solutions are you recommending for companies that are looking to go do an IPO?
Yeah, I think, it links very much both of the topics that Sam was talking about. So you see, a lot of private equity-backed businesses that we happen to work with, and, IPO, especially for a number of the larger portfolio companies, might be the only, option, but they don't know that they can necessarily go yet, or, they haven't quite grown into the valuation that they had a few years ago. I know we're going to get into that in a minute. But there can be sort of creative pre-IPO structures that can help them de-risk ahead of that. So a very common problem problem in a private equity company is they're going to be levered in a private context that's not going to work in a public context. Or they might want to pull forward some distribution ahead of it because maybe they're not going to sell as many of their own shares, but they want to get a distribution out to their LPs ahead of that IPO. So we can come in and give them basically what we refer to as hybrid capital that isn't debt. It typically converts automatically at the time of IPO, so it helps them clean up their cap structure, but it's not as dilutive as common, and it gives them the flexibility to bring on some capital again, whether it's to be a growth initiative, to give them some liquidity, or just to straight delever the balance sheet so that they're in a better position to go public, typically in the next 18 to 24 months when they take on a security like that.
So then that sounds more promising going into 2026, right? Hopefully we will have that windfall of IPOs after all, and especially with rates going down, right?
That's the hope.
Before we hop on to the whole IPO M&A space, I just wanted to come back. Alex, so much wealth creation has happened in the private space, so there's always this question of how do I get access to it, more from a personal investing as well, but what are your thoughts around that?
Well, what we tell our clients is don't. don't seek access.
Why?
I can explain why. Yes, sure. Going back to the four kind of core tenets that I mentioned, one of those is fees, right? And fees in private assets or alts in general tend to be really high. So there's a built-in hurdle that's pretty high to beat the returns of public markets. And continuing on theme, or the theme of price, access is great at the right price. What we see, or what I've seen in private markets is, there's the price per share, there's the NAV per share, and then there's what you can actually sell those assets for. And sometimes those three numbers can be pretty far apart, especially the price per share and what you can actually sell the assets for. So I'd be really concerned about liquidity. I've seen funds that are gating withdrawals or, talking about liquidity mismatches where people want to get some of their money back, but they just haven't been the exits or whatever, where the cash or the distributions haven't been coming.
But aren't they marketed like a good alternative?
I also very much dislike the way that they're marketed. I saw a pitch recently that said two or three things. It was low volatility, low correlation to public markets, and they hold up well in drawdowns, which, if I'm honest, I don't believe any of those things. I think they're basically levered small cap equities, with some management skill potentially on top of that. Hopefully on top of that. But I don't think you can tell me if there's a person out there that really thinks that the value of those private assets isn't going down when the S&P 500 goes down or the Russell 2000 goes down.
Well, to that point, I don't know if you guys have followed, there is a new change being proposed that public companies don't need to report quarterly. I'm not complaining. I think I'll be very happy if I don't have to do quarterly results, but that also kind of moves in that direction of a little bit of more opacity, like in terms of information sharing and stuff. And companies are still staying more private for longer. And Samantha, we were talking about it, right? We were fascinated by unicorns a decade ago, and then we had decacorns, and now we have $500 billion companies, OpenAI, now Tether, that refuse to go public. What's going on? How long can this continue?
I think it can continue until shareholders revolt or, limited partners revolt, or there's some sort of regulatory change. Barring that, why would you change what you're already doing? You have no incentive to change. But the melding of the public and the private is really interesting because, as you said, having potentially a public company not have to report as often, private companies are able to raise larger and larger rounds, very large scale growth rounds, and maybe they don't need to go public anymore. I think that used to be every CEO wanted to go public, that was what they wanted to do, and I think with the markets changing, that doesn't seem to be the end goal that people are really aiming towards anymore. And I think that has so many implications across markets, public and private, equities, bonds, infrastructure.
Yeah. Why go public when you can be a $500 billion company just being private, right? And why deal with analysts like me? M&A. With rates coming down, we were hoping there'll be a lot more activity. I have seen some in my space, like the FIS global deal was a big one, but a lot of eyes are still waiting for more, right? And this overlaps with the time when PEs are struggling to realize their investments. So valuation bid-ask spread still pretty high. How do you kind of bring those two things together, Scotty?
Yeah, it's a persistent problem, again, related to really all of the themes that, we've touched on so far. There was just speaking to the private equity disconnect in particular, there was some research out, I think, from Hamilton Lane a couple months ago, and it showed basically, the marks in private equity portfolio companies relative to the market clearing price, and it's like a number of the sectors were, a gap of like 25+%. So it's, no mystery as to why it's really hard to get, transactions done at this point. I think that's why, at least in a private markets context, you're seeing a lot more interest in structured capital, as there's just a recognition that you can't get a plain vanilla, LBO done in the same way, and maybe in some certain circumstances you're going to have an excellent strategic outcome, but especially if it's like a PE to PE trade, that's really challenging to do right now. But if you use sort of structured capital, you can use various bells and whistles so that maybe you don't have to set a valuation, maybe that valuation moves, maybe you can give a certain headline valuation, but in the background there's some minimum MOIC and other types of protections for the investor, so that they're de-risked to the extent that valuation doesn't materialize. So I think it's driven a lot of interest in the structured capital alternative to create some kind of liquidity mechanism or help facilitate M&A so that they can, grow into their valuation, which is always a fun phrase.
I thought you really need to wash off all your 2021 sins before we can actually see some unlocking happening.
It's just going to take more time.
Yeah, no, but I think that's a good out. Like structured capital looks like a good out. So looking forward to seeing a bit more of that.
We think so.
I cannot get out of this room before addressing the elephant in the room, AI, of course, right? So we discussed about the risks around AI capex and especially with the weakening environment, and now NVIDIA investing in OpenAI, that's kind of a whole different conversation about circular investing, right? And it kind of gave me the vibe of a little bit of the whole global financial crisis, where we completely ignored the risks of interlinkages between these companies. I'm just curious, how real is this concern around over-investing in AI? And maybe let me start with Sam. Do you think we are in an AI bubble already?
Maybe. I mean, if you've read the press in the last 3 days, it's like the word AI and bubble have come up more times than I care to read. But, that being said, the amount of money that is going into AI across different projects and asset classes, the way that it's transforming business life and personal life, I'm probably not the, first person that people think of when they think, are you using AI? It turns out I am. That's shocking to me. I think that, my kid would use it, or, the younger generation would use it. But I'm using it every day. And so, when you have that level of integration, I think, even if we are in an AI bubble, it can go on for a very long period of time.
That is the key question, right? So usage is one thing, but how do you make money off it? So let's poll the audience, guys. You've had enough sitting down. Let's hear some thoughts from you. How many people here think we are in an AI bubble already? Raise your hands, please. Very few. That's amazing. How many of you worry about being overexposed to AI right now? How many of you wonder we are not enough exposed to AI or have missed the last cycle? Now I'll see a bigger raise of hands, I guess. Okay, so coming for you, Alex. Mag 7 clearly weighed, you saw them grow grow their proportion within the S&P 500. The last leg was obviously a lot of AI rally. How does Wealthfront recommend positioning on the whole AI trend?
I guess there are two sides to that. One for the people who think they're not exposed enough and have FOMO, and for the others for the people who worry they're too exposed. For the FOMO folks, you're invested in AI. If you're invested in the stock market, you're invested in AI, whether it's companies that are making chips or data centers or models or energy. There are AI exposures all over the place in the stock market. And for the folks who are concerned that they may be overexposed, we just, again, stress diversification. The top 10 stocks, which are, very, very techy, a lot of AI investment going on there, about 38% of the S&P 500, about 32% of the total market, and about 20% of the global market. So you can diversify away quite a bit of that exposure.
So don't chase the AI rally. Diversify is what Alex is suggesting. Well, thank you so much for chatting with us today, unpacking not just where the risks lie, but also where the opportunities are. To summarize, the one thing that I want everyone here to take away is that this is not a market for complacency. It's a market for going down to the drawing board, focusing on fundamentals, grounded in data, guided by discipline. And I think that's what the common threads of what I had, the conversations with these panelists, not just on stage, but also off stage. So thank you so much, and have a wonderful evening, you all.
Thank you.
Thank you so much for staying, for being an engaged audience, for putting the questions through to the screen. It made our jobs a lot easier. Also, I want to thank Invesco for their help, for their support in this event. If you would like to find out more information about them, you can go to the resources page that's over on our event website. And if you saw something or you heard something that you didn't get to write down, you can watch this event again. Head over to BloombergLive.com and you can watch it there on demand. So check for the Future Investor for that too. We have another event in the works. It is November 4th in Houston. If you can't make it, sign up for the live stream and you can always tune in that way. Thank you everyone. For those of you here, we have some networking, some reception going on, some cocktails for those of you on the live stream. Have a good night. Thank you.